Hi everyone, welcome, and we really appreciate you guys being here. I know you could be watching two-time Super Bowl champion Eli Manning right now, but fear not, I also won a championship in JV high school 30 years ago, the Catholic High School Football League Championship in New York State, so you're in good hands. Honestly, we are talking about a really interesting topic today, private credit. It is the largest or fastest growing private asset class in the world. It's gaining interest from institutions, individuals, RIAs, endowments and foundations, so I'm happy to have some really great players in the space up here with me. And I'm gonna allow each of them to just describe what they do individually very quickly, because private credit means different things to different people. So, would you like to start, Mike?
Good afternoon, everybody. I'm Michael Gross. I'm a co-founder of SLR Capital Partners. We are a boutique private credit manager based in the US. We manage about $13 billion in capital split between public BDCs, SMAs, and institutional and high net worth funds. Our investment strategy is focused on cash flow lending to the upper end of the middle market, to life science lending, asset-based lending, and lender finance.
Great. So my name is Jason Mudrick. I'm the founder and chief investment officer of Mudrick Capital. I love that 13 billion is boutique. So we manage $3.2 billion, so we are boutique. We are the token distressed credit manager, so we don't originate credit, we buy credit that's trading at discounts to par with a focus on North America and Western Europe.
Thanks. I'm Tim Lauer, I'm the CEO of Willow. We have assets under management about $5 billion. Our strategy is simple. It's lower middle market, core middle market, senior secured loans to sponsor, backed, and non-sponsored companies. We think this is a fantastic vintage for investors and are excited to join the panel.
Hi, John Brignola of CIFC, LBC. I'm co-founder of LBC, started about 19 years ago. We manage about $3.9 billion. Our core strategy is direct lending in the US, core middle market to lower middle market. We manage commingled funds as well as managed accounts.
Tim, you mentioned this could be a good vintage. Could you possibly compare the opportunities that you're seeing today in terms of great investment opportunities and also the risks that you're seeing today versus a time in the past, call it when there was like an actual part of the normal cycle that wasn't affected by COVID, perhaps 2019? Can you just compare the two opportunity sets?
I think this is about as good of a vintage as I've seen in my career. I've been doing this for 20 plus years.
Better than post-GFC?
Yeah, I think there was less uncertainty post-GFC, or more uncertainty post-GFC than there is now. And, you know, I'm not a distressed investor. I'm not somebody that's looking to generate a lot of alpha through par build. And so what we do is generate income for investors through the base rate and spread, sometimes fee and call protection. And all of those elements right now are about as good as I've seen. And so for us, distress isn't a part of our investment mandate. We don't really look at opportunities to invest in companies where we think the outcomes could be priced as binary. And as we've gone through our years of development, we haven't seen a lot of distress other than COVID, which was obviously a pretty ephemeral blip in loan pricing versus the GFC. So it's not as if we won't focus on it, but right now you can make for performing businesses with great management teams at 30% loan to value, a 15% or so IRR, that's a private equity return, that's an equity return. And people ask us all the time, what has to go right for you to achieve those returns? And I think the answer is we have to collect principal and interest. And that can accommodate so many outcomes, both macro and micro for a company. So again, the risk that we're taking for the return we're earning right now, I think is about as good as I've seen in my career.
Mike, what are your thoughts on the vintage this year?
Yeah, I completely agree. I think this is probably the best vintage we've seen in decades, frankly. Pre-COVID, we were fighting an environment where base rates were next to zero, spreads were incredibly tight, the BSL market was pricing things to perfection, and we were turning down deals at 6 to 7% yields that today, to your point, we're seeing at 13 to 14%. I will caveat by saying, everyone talks about this being the golden age of private credit. and I've been doing this for over 30 years. It's a golden age from the perspective that the risk reward is about as favorable as it gets, but it's also an environment where it's a challenge to put capital to work if you're too large in the space. LBO activity has come to
12 billion is not too big, though.
Pardon me?
12 is not too big, though, right?
It's just
Okay.
right.
Just
right.
perfect size for what we do. But my point is that in the environment we're in today, where rates are where they are and spreads are where they are, new LBO formations come to a screaming halt. And so if you're a platform looking to put out $2, $3, $4 billion a year into private credit LBO-backed companies, you're going to struggle to find that. Right. If you're of our size and scale, where for us a meaningful investment is $100 million, we're able to find situations where private equity sponsors want to grow their existing platforms by doing acquisitions. And rather than opening up their credit facility for complete repricing, which would be prohibitively expensive, they'd rather take on $100, $200 million of incremental capital, pari pursue the existing debt, but price much more attractively.
John, let me get your thoughts on it. So,
Yeah, I'm sorry.
Go ahead.
I think, Michael, you have a great point. The add-on activity has really, add-on meaning there's a platform acquisition and the sponsors grow that platform through add-on acquisitions. And that add-on activity has really driven origination volume at our firm over the last year. And in an environment today where there's subdued platform M&A activity, you really need to be selective because, although the risk-adjusted returns are very, very attractive, if you're looking for financing in a market where there's not a lot of deals for people like us to lend into, they tend to get a little bit more aggressively priced than we would like. I know at LBC, we've passed it.
Feeding frenzy for the deals that are out there.
Handful of deals, yep.
Yeah. So everyone agrees, base rates are higher, you're getting paid more in fees and OID or whatever. How is that value for money you're getting for the economy that you think we're going to see in the next year? Not what we have seen over the past couple of years, which has been a very strong economy, inflation's been coming down, it's slowing economy, but things have been pretty good. What do you guys forecast for next year, and do you think you're being appropriately priced? You're getting the appropriate pricing for the risk that you see in the economy next year?
I'll start. I do. I think we're getting overcompensated for the risk we're taking. We haven't seen sustained high rates in a period where the economy is growing the way it is. We just had another GDP print, very positive. We're not an index player. We don't invest in all parts of the economy, but in our portfolio, I think we're seeing something like 90% of our borrowers growing year over year. That is a very favorable opportunity set for forward earnings. We're not seeing a lot of companies miss budgets. Again, we don't invest in consumer retail. We don't invest in restaurants. We don't invest in oil and gas or power gen. Purposefully, we don't want to be in the parts of the economy that suffer the most or suffer first if we hit a recession, but we're not seeing that demand destruction hit. And again, we've been making 15% and putting out 15% dividends with this backdrop of a healthy economy. So we like what we're investing into. I think spreads are starting to tighten a little bit with the supply-demand imbalance between new issue and capital forming. But we have 100 borrowers. They all need capital. I think that's a source of origination. I would also argue that it's making our asset class safer because we're in these businesses. We know them. We've seen reporting for 2 years. We've met the board. We've met management. And every time they need capital, they have to come back and ask us for it so we can determine the level, how it's priced, what the structure is, clean up the covenants, change definitions. All of that's happening, and it's all investor friendly.
So it brings up an interesting point because I think there are, yes, you do know your companies better than most people out there, except maybe the sponsors that are backing them, right? But when problems do occur, I think in private credit, you don't have that efficiency of the public markets to instill discipline on corporate boards and the executives, right? Because you're around the table with people who are direct lenders to you, and they're going to want to fix the problem or extend the runway, and so you're not getting that market discipline of forcing companies to do something, right, that they otherwise wouldn't. So as problems will build in private credit portfolios over the next couple of years. I think it's 40 or 45% of all private credit is coming due over the next 2 years, maturities. I don't know, Jason, is that something that, as a distressed investor, are you chomping at the bit to see these problems arise, or?
Yeah, so the syndicated loan market and the high yield bond market, these things trade, right? Whereas what these guys do, it doesn't trade. So it gives us a bit of a different perspective. And I'm not saying they're right or the syndicated loan market's right. There's more sentiment and market forces and flow of funds that impact tradable securities. But what we're seeing is that the catalyst for our opportunity set so far has been rates, right? Like the economy's held in. I agree, it looks pretty good right now. But it's a little bit of heads I win, tails you lose for the existing market that trades, right? If the economy stays good, we're in a higher for longer environment. And the problem is there's just too much debt on these LBOs. 6 turns of debt was the average at new issue. That no longer works. Right? 4 turns cost you 10%, 5 turns cost you 12. Can't really do 6 in most businesses. And if the economy turns down, then maybe rates go lower, but then you have an earnings problem, right? For the existing debt that trades, which is our opportunity set, again, regardless of what happens to the economy, there should be a lot to do for a long time.
I totally agree with that. I think, again, to hark back on this being the gold age of private credit, kind of the dirty little secret people don't talk about is, the vintage portfolios that exist.
Yep.
And they were constructed at 6 to 7 to 8 times leverage with 0 interest rates, where at the time, roughly 45% of their free cash flow went to debt service. Today, where rates have gone, it's close to 80 to 90%. And to couple that, they haven't gotten the growth that they anticipated. So I do personally believe that there is a lot of stress to come into the system. I think one of the advantages to your earlier comment about private credit, and we don't have the public market as a discipline, what we do have though is the ability to get to the table quicker and negotiate it out.
Right. Which is why you're not seeing actual...
With a club of lenders who are like-minded. And you don't have to worry about it trading to distressed hands and become into a lengthy process.
Which is why you see more distressed exchanges, right? Forced distressed exchanges instead of defaults in these names. You're not going to see defaults significantly pick up. You'll see a covenant breach early, and you can get in there and
if
fix the
there's
problem,
covenants.
Right? Yeah.
I don't think that, the public markets, there's pressure to do something, right? There's pressure from the stakeholders to get something done. But even in our markets, there are covenants that get us to the table, as we're saying. We as lenders, we can't just sit with zombie companies. We have to do something at some point. Our funds have lives, or the tails in our evergreen structures have lives. You can only withstand so much of the kicking the can concept before you really need to take some kind of action to generate an outcome.
Yeah, I would say that the protections in private credit documentation are far superior than what you'll find in the syndicated market. There's an ability to enter as an outside party because it does trade, and if a downgrade hits, you're going to see the loan market probably drop to a level that's below value. So that's an opportunity, but we don't kick the can down the road. If there's a maturity, things have to change dramatically, or we can foreclose. We can use our creditor remedies, and all of us that do private credit are relied on by our investors to do that. It's, can you actually take over a company? Have you underwritten the downside case? Can you cut corporate overhead? Have you identified a buyer? Do you have a management team that can run this business? And if we don't answer all those questions to the affirmative, we don't invest in the first place. And so I think as a private credit investor for many, many years, we've gone through cycles, and sometimes you have to use your restructuring skills and talent. And I think we're very prepared to do that, even though so far we haven't really had the opportunity to do it.
So Jason, when you're investing in a distressed company that needs to be restructured or to take it through bankruptcy, would you rather be around the table with guys like this, or people who are, CLO managers or broadly syndicated loan market, kind of more, broadly syndicated parts of the market?
That's not fair.
Be honest. Be honest.
I'll tell you who I don't want to be around is other distressed guys. So no comment on that. But that's a risk we take. I mean, generally speaking, I think for comparable risk, distressed guys can make about 2x. Every situation's different, but
over
2x what you could get in originating credit. Okay, but you're taking different risk. If we just look at where we're attaching in the value chain, and we're in it 4 or 5 times, and we can make 20 versus 10 to 12, that's a 2x, but we're taking all kinds of other risks. We're taking creditor on creditor violence risk. We're taking process risk. We're taking sponsor on creditor risk. We're taking what happens to the business in a restructuring. Does value deteriorate? Does management leave? It's a unique skill set, but you get paid for it.
Yeah. It's actually very interesting, like sponsor versus non-sponsor. We're starting to see defaults and recoveries and some data to look at for the past several years. And recoveries are significantly higher in private credit restructurings and bankruptcies than they are in the broadly syndicated loan market. And I think it's because of all the things you guys are talking about, right?
It's
you have
covenants.
the covenants, the early trip warnings, and it's showing through in the numbers now.
Yeah.
But I think it was Tim, you mentioned the vintage problem, right? Like there are maturing portfolios of private credit out there. And one of the newest trends, and it's gaining a lot of popularity very quickly, and I think you guys here have taken advantage of that, is raising capital through different channels and in different vehicles, particularly open-ended vehicles, and vehicles where investors can invest at a NAV and have redemption rights of some form. So I guess the question is, how does, as an investor, as an allocator, if I have the opportunity to invest in an open-ended fund that is more mature, it's got an older portfolio, how can I trust the NAV that I'm investing in? Do I have to worry about that?
Well, oftentimes.
They get a claim of securities fraud.
Yeah, I mean,
That's how you trust the NAV.
There's lots of different ways to mark a book.
It's not the NAV I'd put into question, it's the quality of the underlying portfolio and how it's going to perform. And as a retail investor, investing in a mature, closed or open-ended perpetual BDC, which has 150 names in it.
Or an interval fund.
There's no way you can diligence that. There's just no way. So you're relying a lot on the manager to be honest about what's on the watch list, why it's on the watch list, and I think importantly you have to look at what the underlying portfolio is. Is it exposed to those industries that will suffer during difficult times, or is it concentrated in things like healthcare and business services that won't?
Right.
You're getting the benefits of diversity, absolutely, 150 name position or portfolio, tremendous diversity. But you do have to think about how these businesses are going to perform over the next year or so. And when you want liquidity, can you actually get out? That's the other real question.
Yeah, it's an interesting time in the markets, one I haven't seen in my career, in that you've had this sort of normalization of rates. Like rates are back to where they were in 2007. Okay, but in the zero rate world that we just came out of, valuations went up about a turn every 2.5 years. Okay, so you saw this massive growth, let's say from 8 turns on average in both private and public markets, 8 times EBITDA, sort of cash flow, to 12 or 13 times today. Rates have gone back up, but valuations are the same. So when you talk about private valuations versus public, it's created this interesting dichotomy, and I think this is why M&A activity was down so much last year. There's a ton of sell-side processes being run, but they don't transact because of the bid-ask. Like if you're a sponsor, you can't put 6 turns of debt on a business, or 7, or 8. You can only put 4 or 5. But the public markets are still valuing these businesses at 10, 11, 12 times, so you have to over-equitize them. And by the way, the lenders for that 4 turns are charging you 10%, not 5%. So the LBO math is just completely broken. So you come to the valuation question, like I know deals that we're in where the debt was trading at 50 cents on the dollar, the senior debt, and I know that I won't name names, but I know that the sponsor had their equity marked at cost. And I go to them like, how is it possible that the first lien debt's trading at 50 cents, creating the business in this particular situation I'm thinking of at $1 billion, and you paid $3.5 billion, and you still have your equity marked at $3.5 billion. And they said, well, the comps are still trading at 14 times EBITDA.
Right.
Like your guys' market's broken.
In the private credit world, some of the things we've seen is we know a company's tripped a covenant, or they've been given a break on paying interest for a quarter, or the loan was extended, and the loan is marked at par, right? And it probably shouldn't be. That's the problem we face as allocators, that we have to sift through that. And we'd love to access great minds like yourselves and invest with them, but we have to be very careful of that situation as an allocator.
You should be spending time understanding how they're actually marked, third-party marks, what they're doing, how they go about it.
A lot of times those third parties take a lot of guidance from the managers, right? They're not thinking critically about it. They're being given guidelines by managers who are giving them a kind of a methodology by which to do it, right? So
hopefully the manager's using multiple firms as well.
The other issue to your initial comment about private credit having all these different meanings, senior secured loans have different meanings too.
Right.
Yeah,
there is traditional senior secured, then there's unitranche, and there's second lien that people are calling senior secured. And the amount of unitranche exposure that's out there is tremendous, and that's nothing more than a first lien and second lien in drag, if you will.
Right.
And that, those recoveries won't be anywhere near where historical recoveries have been for first lien secured loans.
Right. Just going back to the open-ended vehicle, because it is such an interesting topic, and there's a lot of money being raised in it. Forget about the NAVs, but when redemptions do start, and you guys don't have these problems, right? At some point, but there are very large firms out there that it's been public, they've had redemption problems. How how are they able to continue that business and be as aggressive as they should be, putting capital to work in good environments like the one we see today when you're having redemptions? I mean, it's a problem that I have a hard time getting my mind around.
Well, I think the problem is actually deeper than that. It's not just the redemptions, it's the incentives. So the problem with these open-ended structures is, as opposed to most of our funds we manage drawdown funds. When we see opportunity sets, we draw down capital, we invest it. These open-ended funds are like mutual funds. So the money comes in, and guess what? The manager must invest it, no matter how good or bad the market is. And so what you've seen with these huge vehicles being opened up is people are just buying the market. And it's less about the redemption issue because they'll manage a redemption issue. It's 5% a quarter.
Right.
They'll keep enough capital in abeyance to do that under credit facilities. They will miss out on new vintage stuff if that does happen. But I think the bigger issue is what's being invested in those portfolios.
Tim, we talked just before getting on here about BDCs, and obviously, it's becoming an increasingly popular way to invest in the private credit world, and they're great efficient vehicles. But there's always the question whether or not you should take it public, right? And is that a good option for investors to get liquidity?
I think that the one thing, whether it's a non-traded BDC, a private BDC, or public BDC offers investors, it's liquidity. And folks tend to really prefer a public BDC because of its daily liquidity. And what I would say is the negative about that is you are going to see a stock price that reacts to more than just fundamentals and value. It's technicals, it's where the overall market is trading. Is it correlated to the FIG market, the REIT market? And for large investors, if they're in these traded vehicles and they own 30 million of $1 billion market cap, they're not necessarily going to get liquidity when they want it. And so we have non-traded or private BDCs that offer quarterly liquidity, and we find that it's a very orderly way for that investor to access liquidity. They don't have to just look at it as a redemption opportunity. They can transfer their interest, et cetera. And we're marking our portfolio according to its fundamental value versus being stuck with, I managed a BDC at a primer shop and saw it go up and down. And we thought that there's no way the stock market price reflected value. But that's where it trades. And if you own that as an institution, that's your path to liquidity. So I think there's positives and negatives about having drawdown funds, SMAs. I think the good news for investors is there's a lot of choice there. And so if you value long-term perpetual vehicles that you can compound with a good manager right now at a 15% return, but you may or have clients that may want access to liquidity, there's quite a few options for folks today.
The instruments we trade, I use that in quotes, but there's quotes, people make markets, but one thing I've learned the hard way over the course of my 23-year career is you have liquidity when you don't need it, right? And the minute you need it, everybody's looking for it and the bid disappears and you own it. And this is stuff that's tradable. So I don't know all the details of how this stuff is structured and with gates and whatnot, but I don't see how you offer private credit in an evergreen structure. I mean, I can see how you could trade it, but that's not an evergreen structure. That's permanent capital that trades, so people have liquidity by transacting it.
Right.
If you're
But by the way,
trading
those
it,
marks are going to be pretty tough too when everybody wants out at the same time.
There's a lot of market cap on the other side of that argument, unfortunately.
but if you're trading it, you're also exposing yourselves to much greater volatility, which one of the reasons to invest in private credit is you limit the volatility. It's just I guess a preference by the actual investor.
So along with institutions and high net worth individuals and ultra wealthy getting into private credit, we're seeing other very large pools of capital increase their exposure to private credit. And we're seeing a trend where alternative asset managers are merging with insurance companies, right? It's a great form of capital. It's low cost capital, and more of that capital is finding its way into the private markets and into the middle markets. Have you guys seen players come into your space and change the dynamics of the deals that you're trying to get done?
I think it's always been here. There's probably more of it, and there's more of a traditional convergence between alternatives and insurance company cost of capital. There's been M&A that's happened in the insurance space, but New York Life has backed Madison and now Apogem for years and years. When GE Capital was in the business. They had the lowest cost of capital that was out there. They were a tough competitor. They're no longer around. I'm not seeing any meaningful change. For me, it's, do you want to raise money by issuing liabilities and owning an insurance company, or do you want to go raise money in more traditional channels? And I think the largest players are doing both. I think the asset class is growing well in excess of all this capital that's being formed, whether it's in the insurance, the retail, the institutional channels.
There's enough supply, you think, to take on?
Absolutely.
Yeah, I mean, just look at some of the deals that have been announced in the private credit world, upper size deals, $3 billion, $4 billion, which 10 years ago, I never would have imagined that could happen.
So we talked about the vintages and perhaps problems boiling up in people's portfolios. You guys have great portfolios. We all know that. There are no problems. But where are you seeing signs of stress in the portfolios that you do manage? Which sectors, what industries? Is anything bubbling up?
Honestly, not in our portfolios. Again, because we're on the cash flow side, we're predominantly healthcare. So we haven't seen that. On the asset-based lending side, there's noise, but we have such tight borrowing bases that we're at the table when there's noise and we're able to solve the problem. There's definitely more noise than there has been in the past, but we're not taking additional risk in handling that.
I think where you're looking at default risk and you're an owner of a company, you have a very long runway to solve it, versus COVID when businesses had revenue models that turned over overnight. We saw middle market management teams react incredibly to that environment, recreating business models, finding ways to keep their businesses open, servicing their customers. Right now, there's a single line item that's blown up your cost structure. You can hedge that, you can cut corporate overhead, you can manage CapEx, you can negotiate with your lenders. These are all skill sets that a good management team can actually put in place. So I think that is happening, and that's why you're probably not seeing this rapid rise in interest rates, while it's limiting coverage, really result in a default curve right now.
And the stress we're seeing is all because of the interest line item. The earnings, generally speaking, are okay. Like if that shoe drops, it's a different story. But right now, it's just, LIBOR went from 0 to 5.5 really quickly. And interestingly, I don't know about your guys' portfolios, if you covenant this or for sponsors too, but 75% of the LBOs that we see did not have any interest rate hedge, even though it costs almost nothing to hedge your rates. None of them did it.
It's crazy. It's too late now.
It is too late now. But I think it's an interesting point. I think that this distress cycle will be very different. I've been through invested in ones in the past, and it's a much easier proposition to try to fix companies' balance sheets that are driven by interest rate issues and debt issues than operational economy issues. The degree of difficulty and restructuring companies are both going through operational issues and financial issues is off the charts. This will be a different wave. I think there'll be a big opportunity set, but it's going to, sort itself out quicker than historical cycles.
Yeah, the good business, bad balance sheet really hasn't existed until the last couple of years.
Right.
If you were distressed 5 years ago, you had an issue. That wasn't just your balance sheet.
Guys, I'm sorry, we have to wrap. We're out of time. But thank you very much for joining us.